when we turn to China, problems continue to arise that we've been talking about on the economic front. And as even the official data comes out, it just confirms what we've been saying. And not to say, oh, look at us, we're always right. It's just, no, it's like we're following the trends and we're looking at what is shipping doing, what are their imports, exports. We can follow the boats just based on the data that we have. And we're just showing exactly what is happening and the concerns that we're seeing from the consumer all the way down to the corporate entities. So one of the key pieces that we talked about coming out of the Communist Congress was very important. And it was that there was less and less focus on the economy and expansion. And there's always, and it happened, and we really actually called it, I think we actually named a show about the pivot to party focus, focus on security, the focus on socialism and communism and the CCP as the entity. And we really need to look at common prosperity and not just on the piece, which you've heard me say it a billion times. Deng's view was let some get rich. And that is now coming to an end. And you're seeing that pivot as you look at expansion and less of that focus on expansion. Science and technology, economy, market reforms opening up is diminishing, and there's a much bigger talk about security and party focus, and that's a key component. But look at the Chinese international issuance of debt securities, and when you look at it, it is exploded versus on the different pieces on international debt securities claims on China, nationally basis U.S. dollar. And it's over $1 trillion and it's coming down, but that explosion really pivoted, as we've talked about it in that, obviously after 2008, but in 2014, we saw it go parabolic. And that was when we said this is going to end poorly because there's so much debt being issued and there's just not the offsetting growth. Because so essentially, if you break it down, roughly speaking, for every $3 borrowed, they only generated $1 of GDP. That is an inherently negative backdrop in terms of growth. And now you're starting to see that pivot, which is why there's only so much QE that can be done. There's only so much investment in infrastructure because typically exports drop, they invest in infrastructure. But you can only build so many ghost cities. You can only invest so much in these things that don't generate any cash flow. And not only don't generate cash flow, they're actually negative cash flowing. And that becomes an even bigger overhang because there's only so much borrowing that can take place. So when you look at China home prices fell for a seventh consecutive month, down 2.4% year on year, with less than 15% of cities having rising prices. Construction activity, which has historically led home prices by about 4 months, suggests that the year-over-year price decline is very close to a low. But construction activity is flatlining. We don't see it going up. And it's just because they can't get the borrowing. And the CCP and the PBOC have directed banks that, excuse me, you have to lend more. You have to lend more to these entities. But they said that in 2021. They said it in February of this year. They reiterated it again in May of this year. And they're saying it again. But there still hasn't been any new borrowing because the leverage, the companies don't want it because they can't handle the leverage. And the banks don't want to issue it because they're also seeing their own leverage ratios, which were already averaging 34 to 36 times. And that was before the collapse in home prices. Well, what is it now? What does that asset write down look like? Which is why we've seen some of these different pressure points. Now, before we go into the different pieces, here's a quick summary. Retail sales fell 0.5% year on year in October, down from 2.5% year on year increase in September. Fixed assets rose 5% compared with 6.6% in September. Value-added output at industrial firms rose 5% versus a 6.3% in September. All of that missing estimates. Analysts had forecasted 5.2% increase in industrial value-add, came in at 5%. Retail sales had been expected to increase 1%, came in at negative 5%, 0.5%. Year to date, fixed asset investment has been at 5.8%, missing expectations. Things have been looking up in September, but then again, there's been no turn in recovery. Tightening COVID restrictions into the run-up of the Congress was partly to blame. Catering sales also plunged, and lockdowns obviously also hit unemployment. But given all these dynamics, it's no wonder that businesses and household confidence is still in the doldrums. It remains difficult to see how policymakers can jolt the economy back to life in the near term, barring a more significant and accelerated relaxation of COVID controls. But we're going to talk about what that has looked like, because they started to do it in terms of getting rid of the controls, but now there's been a massive explosion of new COVID cases, and they're starting to be, well, do we follow? Where do we go from here? Because there's been some double talk coming from the CCP and the NHC, the National Health Council, about what should be done to try to counter some of this. So when we look at retail sales, Chinese consumption growth has been incredibly weak over the last 2 years. Industrial expansion has relied on infrastructure and export, but because retail sales haven't been there. But look at even in reopening periods, because everyone's blaming lockdowns. But even when they weren't in lockdown, we never saw them get back to trend. We've never seen them get back to a real growth. And then real retail sales fell slightly to pre-pandemic levels, showing zero growth in over 2.5 years and standing at 17%. And that is with common prosperity. That is with, tax refunds, tax rebates, tax cuts, already stimulating QE. They've already tried to push through increased spending, increased debt, increased lending, decreased rates. And they're not getting anything back for it because there is still such a fear. And the fear is coming on top of what is already a kind of an Asian mindset of saving versus spending. And again, that's a broad sweeping statement about Asia, but typically in the West, there is more of a spending mindset, and in the East, a bit more of a saving mindset. So that has only gone into overdrive when you look at the issues before them and how over-levered all of these Chinese individuals are. Because remember, the Chinese consumer is massively levered to real estate. The only group of individuals that is more levered is South Korea, and that is just by a small margin, which is why these huge write-downs in asset prices, in home values, is going to be something that they won't be able to overcome quickly. Fixed asset investment also in modest contraction, with manufacturing investment still rather resilient. So fixed asset investment has come down, but manufacturing continues to remain at a steady pace. But as you get more offshoring, nearshoring and onshoring, which is going to come away from China, we expect to see more of that movement to the downside on fixed asset investment. While other components continue to show strong infrastructure spending, whose growth evolve around 10-year average, while real estate investment plunges more than 15% to new cycle lows. So infrastructure spending is still been the driving force, but the law of diminishing returns gets in the way here, because they've been always using infrastructure spending. You are going to invest in infrastructure, and we're going to do this, and it's going to be great, and this is how we're going to offset the slowdown in exports. Well, exports have slowed. They're now a smaller component of your GDP. How much infrastructure spending can you continue to do, given the fact that you're tearing down ghost cities and uninhabited buildings because there's so many of them around? And that's why when you look at real estate, that's going to eat into how much infrastructure spending can really happen again. China main activity indicators for October were generally weaker than expected, declining on a month-over-month basis. Real estate sector disappointment again as floor space starts remained at 13-year lows, while residential demand dropped back to cycle lows. And again, we're not seeing that adjust anytime soon. Overall construction activity was unchanged at cycle lows and 23% below pre-pandemic trend, while bottoming out on a year-over-year basis. So you're still seeing, again, those headwinds, and this is with a clear directive of these guys investing in building and construction, And you're just not seeing that, even though the rates have come down for it and there have been carve-outs made specifically for it, and we're just not seeing those indicators. Industrial production was one of the only indicators that this month to avoid a contraction and continue to move around the trend line. But as the industrial side slows, as exports slow, this is where we think it's going to be kind of the last piece to slow down, and where we see some of the underlying next shoe to drop. PBOC household survey, investment and consumption intentions, more savings, less consumption, less investment is continuing, and we don't see that changing. And again, the reason why is because home prices continue to move lower. People are highly levered to this, especially in China, driving things lower. Now, when you think of case numbers are surging as outbreaks become more widespread, China's COVID policy remains the most stringent in the world as cases go up. So when you look at the movement, so on Monday, there was widespread confusion for Xinjiang's party chief to publicly deny the city had given up zero COVID. We are by no means lying flat nor totally letting it go, and this is absolutely not a so-called full opening up. On Tuesday, many public testing booths had reopened, and authorities vowed to keep at least 30 testing booths open in each city. As long as zero COVID remains the policy of the land, local authorities and private businesses must keep many restrictions in place to avoid prolonged lockdowns. Chaotic implementation of the recent policy adjustment will complicate policy review and design in Beijing, delaying further moves towards relaxing a zero COVID. And that's a long way of saying it's not going anywhere, because zero COVID is still the law of the land. And when you do any type of loosening up, and we've seen it, Omicron, when Omicron was the main strain, if you looked at someone, you got it. So now all of the ones that have come out are more contagious, less severe, but more contagious. So as you loosen these restrictions, this is only going to get worse as we go forward. Changes in PPI and export prices will come down, which should be a positive for moving some of those exports through. But newly started residential real estate construction not going anywhere, well below the previous few years. And again, we don't see that changing. And even as export prices should come down, how much they come down is going to vary, because they still need to support their spending. They're spending a lot of money to try to support local consumption and keep prices low for the consumers. So again, you're going to get that from the external market, and they need dollars. They need foreign reserves. So if you keep export prices elevated, that allows you to bring in some of that excess capacity. Chinese stocks in Hong Kong and on the mainland surged over this month, and it was on the back of the PBOC and the CCP reiterating everything they've said pretty much throughout all of 2022. So I guess, realistically, it's just because it got to an extreme. Now it's recovered, and we just think that there's a continuation to the downside. Now, when we look at Chinese industrial production, you get some of the slowdown, but it's supposed to slow down. So you're still above where we have been in the past. So that's why this is the kind of that last piece that we see actually coming back below 2021 and 2020. When you look at, we normally get a bounce. We think that the bounce is going to be a bit softer this year and come and actually fall below where we were last year. Retail sales, something similar, where you can see the trend. Do we normally get an increase, but the increase is fading, and based on everything that we've seen, it's probably lower than what's being announced. And that's some of the underlying concerns. When you look at the real data, it's probably something a bit much worse, which is why we remain more concerned on GDP. Same with property investment. You can see it's already trending well below 2020, and we expect this to fall well below where we were in 2019, which is why the expectations of a growth boost is premature. And that's the view of exiting COVID, COVID zero, getting rid of it. But there's so much confusion and unknown, and the consumer is still struggling. Businesses still won't borrow. So how much growth can we really see in general? So then when we look at China monthly new loans, you can see coming in at the low, aggregate financing coming in at the lows, because we're not seeing that cycle which is why it's going to be difficult to see some of this growth that has just not materialized. China aggregate financing, again, coming in at the lows, money supply rolling over. So even, you still have the PBOC pulling back and trying to keep some of the liquidity down, but they're supposed to be issuing more debt and more liquidity, but instead it's still contracting. And this is the law of diminishing returns of what we've been talking about, that they're going to be pinned to what they can actually do, what they can actually push forward. So then when you look at, although all the other vulnerabilities listed by Liu He, it is worrying that Liu is also concerned that traditional advantages such as cost of labor are weakening. Labor costs matter to the extent that they fail to reflect labor productivity, and with by far the lowest household share of GDP of any major economy, it is clear that Chinese households are directly and indirectly paid very little relative to their level of productivity. So how do you promote additional pieces in terms of common prosperity and local consumption if this continues to be the case? If you're not really getting some of this through, if you keep coming this in general, you're not getting a lot of this movement. And as, again, people aren't borrowing, people have a higher propensity to save, you're not going to see an additional support for the local economy. Now, when we turn to Japan, things have gotten much worse. When you look at machine tool orders, came in negative 5.4% versus the last month of 4.3%. PPI accelerated against estimates. It's slowed down versus previous, but again, moving in the wrong direction against estimates. GDP was supposed to be a growth of 1.2%. Instead, it came in at negative 1.2%. All of that is, again, catching up with cost, inflation, all of these other problems that we've been highlighting finally coming through. Exports missed estimates. Expectations were supposed to be an increase of 29.3%, came in at 25.3%. Imports still remain fairly strong, coming in above estimates. So again, they're still trying to bridge some of this gap, but there's a lot of these slowdowns that are continuing to trickle through in the Japanese economy. Cumulative private Japanese purchases of foreign debt securities, when you look at it, it is flatlining and actually starting to roll over. Japan has been a big part of the global bond market for quite some time, both unhedged investors, government mostly, and hedged investors, banks, and lifetime policies. Japan's financial system report is still the best guide to really understanding the associated risk, and you see it rolling over. Japan PPI expected to be at 8.8%, came in at 9.1%. So you're still seeing that stickiness. So that's why when we look at the U.S., we still import that. And that's where we're continuing to see a lot of that stagflation, because we're going to import those prices. But in the meantime, we're going to slow down buying, which we've already seen, and it's showing up already in Japanese data. Net export contribution came in negative, and we don't see that adjusting. We actually see that remaining the case, with private consumption locally staying fairly flat. But because it's an exporting nation, we continue to see that pressure to the downside. Now, when we turn to India, you can see that CPI inflation came in a bit better than estimates, and we'll talk about that a bit more in a minute. The 12-month average still remaining elevated, but we see So Bloomberg Economics has it coming down further. We think that there's a lot of staying power at an elevated level because of commodity prices, mostly food and energy, that is going to bridge some of that gap and act as a tailwind for some of those inflationary estimates. And so when you look at India, wholesale price index was expected to be at 8.5%, came in at 8.4%, but exports are slowing. And that's, I think, the biggest crux of what we've been talking about, where India is now has been kind of the last bastion of Asian growth. And now you're starting to see exports hit, and they're a big exporting economy. And that's why when you look at pricing, when you look at flows, now you're starting to see a lot of that pain continue to hit India. And that's where we see a lot more of these slowdowns in general. Food inflation leads the drop in October, but again, it slowed, but it didn't go away. It's just the pace of which this is happening. And as it remains elevated, it'll continue to hit in terms of consumption and the local consumer and their ability to spend. Core inflation eases slightly, but again, it was 6.3% in September. It was 6.4% in October. So even as broader headline inflation has been reduced, core CPI hasn't. It's actually gone up. And that's why when we look at the local consumer, they're already struggling. We know the buyers aren't out there. We know that there's a slowdown in buying from the external market. Now you're seeing it hit even harder on the internal side. India index of industrial production, small bounce, but continuing to remain. And we think that this continues to slow, especially as exports continue to pare down. So that's what we have for you today. If you have any questions, please feel free to reach out in the comment section on Twitter, because we always love to hear from you. And we hope you have a great rest of your day. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.